Mutual funds versus index funds. Unraveling the distinctions. If you're delving into the world of investing, you've likely come across terms like mutual funds and index funds. However, understanding the differences between these two investment vehicles is crucial, as it can significantly impact your financial future, potentially resulting in a difference of hundreds of thousands of dollars. So, let's take a closer look at the disparities between mutual funds and index funds to help you make informed decisions for your retirement years. Mutual funds. At its core, a mutual fund is a managed portfolio of stocks and/or bonds. Picture it as a company like Fidelity or Morgan Stanley that brings together a large group of investors and invests their money on their behalf. Each investor in the mutual fund owns shares representing a portion of its holdings. These funds are actively managed by professional money managers who create portfolios using the pooled money. Different managers pursue various strategies. Some focus on low-risk, high-payoff investments, while others aim to outperform benchmark indices like the Nasdaq or S&P 500. The objective of a mutual fund is to surpass the investment returns of a related benchmark index, which serves as a measurement of a specific section of the stock market. Mutual fund managers, stock pickers, and analysts work diligently to ensure the fund's holdings are beneficial for the investors, typically investing in a mix of stocks, bonds, and similar securities. While the idea of having a dedicated team of fund managers overseeing your portfolio may sound appealing, there is a significant difference between mutual funds and index funds. Managing a mutual fund with daily or hourly investment decisions incurs high expenses, resulting in annual fees of 3% or more. A not uncommon scenario. For instance, with a $1 million investment, you could end up paying $30,000 in fees annually. Index funds. On the other hand, an index fund is a type of fund designed to match or track the components of a financial market index, such as the renowned S&P 500. Like mutual funds, index funds come in various types, including those invested solely in growth stocks, dividend-paying stocks, international stocks, or small-cap companies. The most prevalent index funds track major indices like the S&P 500 or the Dow Jones Industrial Average. An index fund aims to provide broad market exposure, featuring low operating expenses and portfolio turnover. The fund's composition mirrors the market index, rather than attempting to outperform it. For instance, an index fund tracking the S&P 500 will deliver a return equal to that of the S&P 500, with minimal expenses, often less than 0.2% per year. Unlike actively managed mutual funds, index funds are not subject to frequent adjustments by managers. Instead, the investment mix automatically aligns with market trends. This results in significantly lower management costs, or what's known as the expense ratio. For a $1 million investment, the annual expense ratio for an index fund could be around $2,000. Tony Robbins highlights the impact of fees on investments, illustrating that even a 1% difference in fees can double an individual's account value over time. While the average mutual fund charges 3.1% per year, index funds charge a mere 0.2% annually, making a substantial difference in the long run. Opting for index funds within tax-advantaged accounts or commission-free brokerages like Robinhood can lead to even greater savings. Monitoring and minimizing fees are critical, as they can potentially save you hundreds of thousands of dollars over time. In summary, an index fund automatically tracks the market segment it represents, avoiding the higher expenses associated with actively managed funds. Historically, beating the market consistently has proven to be challenging. Therefore, index funds offer an efficient and cost-effective way to invest, requiring minimal effort and oversight. However, if you're willing to bear higher expenses and have confidence in finding a rare actively managed fund that consistently outperforms the benchmarks, the active route is an option worth exploring.